Good afternoon, everyone. This is Sam McGrasty with Brady Ward Dealership Business Advisors. Welcome you to the November webinar. This month's webinar, hard to believe it's already, we're already doing this, but it's our annual year-end planning webinar. It's going to be hosted by our own Tom Wolf, who's going to walk through some key ideas and thoughts for as we head into year-end 2019. So with that, I turn over to Tom.
Thank you, Sam. Appreciate it. So thanks everyone for joining us for our annual year-end planning webinar. We'll jump right into the first section. So I realize a lot of you have been doing this for a lot of years, but we're going to go over some basic accounting reminders before we get into some other tax considerations here later. But if there's one thing that I can point out during this webinar that maybe you would have forgotten, then hopefully it'll be worthwhile. So we'll jump right in. So just some things to remember on your general accounting records, just as an overall view here. Bank reconciliations, hopefully you're doing those on a monthly basis, looking at unclaimed funds with the state of Ohio, making sure that you're remitting any personal uncleared checks that are over a year and remitting those funds to the state and reporting those as well. Hopefully you're doing that already. Also looking at receivables, making sure all those receivables are collectible. If they're not, getting those written off for tax purposes. Also making sure that if you have any employee receivables, we'll talk about that later on, but those should be done with a payroll deduction. Those are getting collected on a regular basis. Looking at finance chargebacks, a lot of times that statement maybe comes in after the close of the month end, but you want to make sure that you capture those in your year end. If you have any chargebacks for the year, that you get those accounting for in December to get those tax deductions. Hopefully one other thing that you're doing when you do get chargebacks is recalculating the amount of the chargeback to make sure it makes sense. Sometimes the banks can make errors and sometimes you get charged back more than what the original amount was. So that's something that hopefully you're doing already. Also looking at the vehicle inventory, making sure you've got write-downs done. Also making sure that you are observing your inventory. Someone outside the sales department should be observing your vehicle inventory every month to make sure all the cars have been accounted for, especially the ones that aren't on floor plan and aren't subject to the floor plan audits every month or every quarter. So that's another thing to keep things tidy in the accounting department. Also, in accordance with the LIFO regulations, you want to make sure that you have a LIFO estimate in your 12th month statement, which for most dealers is the December statement. So that is required in order for you to be in conformity with LIFO. So you want to make that estimate. Your Brady Ware person, dealership advisor person can help you with the amount of the inflation that you should use to estimate that LIFO change for the year, so we can help you with that. Also look at your prepaid expenses. A lot of times this can become a dumping ground for deferred expenses that happen throughout the year, things that are one-time charges that maybe you don't want to hit the departments for. So looking through that prepaid schedule to make sure everything gets written off in December and adjusted through December, so you truly only have actual prepaid balances for maybe advertising or computer usage or forms are really the true prepaids that you should have at the end of the year, and you should get rid of all those one-time expenses that you didn't want to take during the year. Also the floor plan reconciliation, hopefully again you're doing this on a monthly basis, accounting for your payments in transit and your units in transit. It's important to note for your in-transit units, you are able to include those in your LIFO calculation for the year. So if you find yourself with a lot of in-transit units in December, those can be included for the benefit to get the maximum benefit for LIFO. If you're a Chrysler dealer where these vehicles can take a long time between when they hit your statement to when they arrive at the dealership, that could be a huge windfall for you in the LIFO. Also the capitalization policy, hopefully you have one in place. If you are a dealership with an audited financial statement, you can typically write off anything under $5,000 just to supplies or repairs and maintenance, and then you would capitalize anything over $5,000. Typically, if you don't have an audited financial statement, that limit is $2,500. So making sure you're not capitalizing small amounts. Granted, you can probably use depreciation to take care of those, but just capitalizing the amounts over $2,500 or $5,000, depending on your situation. Also, in regards to fixed assets, making sure that you're disposing of any old or abandoned assets to get those off your books so that you don't have any administrative, administrative responsibilities with those and don't have to account for them anymore. On the parts and service side, making sure you're doing a parts physical, whether it be gas, oil, grease, and whip, making sure those accounts are cleaned up. If you have body shop materials, paint and supplies, those accounts should all be cleaned up at the end of the year, physicals done, and those amounts adjusted. Special tools are also something hopefully you're taking a regular inventory of as well, since those sometimes can walk away with technicians who leave the dealership. So that's just kind of an overall view of the first part of the accounting records section. So also writing down demos. As we talk about later in the section, you can write down vehicles that aren't on LIFO. So demos typically get a lot of use, maybe carried at their original value, but those should be written down to their blue book values at the end of the year, so you get maximize the tax deduction there. Also accruing for real estate taxes, Ohio commercial activity taxes, accruing the interest on your floor plan payable, accruing year-end bonuses to non-owners. If you're an owner of a company, that can't be deducted for the business for those accruals, but if for normal employees, those accruals can be deducted. And also accruing any vacation, depending on your vacation policy and whether it carries over from year to year. Any employee vacation that's due as of 12/31 can be accrued and then would be deducted basically for 2.5 months. So that deduction can help you as well. And then, like I said, if you are a shareholder of the company, things accrued to a shareholder cannot be deducted. So make sure all the rents, interest, and any wages and bonuses are paid to shareholders by December 31st so they can be fully deducted. Moving on to some tax planning ideas here for 2019. Obviously, we had the Tax Act that was new in 2018. So most folks have had a chance to see the impact of that, hopefully mostly for the positive. But it's always important to consider doing your tax planning, looking at least 2 years worth, just because of the changes of the new Tax Act. So you want to look both this year and next year going forward. Some things to note going forward in terms of the new regulations. Bonus depreciation is still there for the dealerships. It was a little bit more limited in 2018 because dealerships pay floor plan interest expense. And so that was written in the new tax law that provided some limitations to the amount of bonus depreciation that dealerships could take. This year, the IRS has provided a little bit of relief on that. There is still some calculations you need to do in order to understand that. So you can contact your Brady Ware service team and we can help you with that calculation and that estimate for bonus depreciation. As always, you still do have the Section 179 expensing available. That is the same as last year. You have $1 million of immediate expensing available under Section 179. But that starts to get phased out once you reach $2.5 million in addition. So maybe if you build a building this year, that could be limited. But for most dealerships that don't have huge capital expenditures, you've got up to $1 million of Section 179 expensing available, provided you have taxable income. There was some limitations also in 2018 with the new Tax Act in terms of what assets can qualify for the Section 179. That has been corrected for the most part, but again, we can help you with any questions you may have on that. A big part of the Tax Act from 2018 was the Section 199A, 20% business deduction. That is the same. Again, it's not just a 20% deduction against all your business income. That's important to remember, some lessons learned from last year. So we can certainly help you determine exactly how that deduction applies for individual taxpayers. So you can calculate your, you can contact your Brady Ware service team if you need help with that. It's important to realize too, there are some planning ideas there in terms of withholdings versus quarterly tax estimates with the new Tax Act. So that's something we can also help with. Also, the entertainment expenses are no longer 50% deductible, so you need to understand exactly what's in your meals and entertainment account and even travel. So those things need to be broken out separately, which I think we recommended last year to make sure you get the deductibility correct on those different expenses. Just a reminder that the standard deduction increase for married filing jointly to $24,400 for 2019. It's also important to note that in Ohio, the state and local tax deduction is capped at $10,000. So where you have real estate taxes as well as other things like that, you have to basically plan for that. So we can also help you plan for those items that may be capped in your personal taxes. And I think I also have mentioned before, especially when it comes to charitable contributions, consider bunching those deductions just because of the standard deduction is so much higher now. If you're going to make charitable deductions, you might want to consider making 2 years worth at one time so that you can get the actual benefit of that, to make sure that your itemized deductions are going to be over the $24,400 limit, so you get a benefit for that. So maybe take a year off and then do 2 years worth on your charitable contributions, things like that. Different tax deductions that you can control. And going back to the depreciation, as I mentioned before, if you do have new construction and a new facility, we can definitely help you with the cost segregation study to make sure you're maximizing the benefit of all your depreciation versus categorizing everything into 39-year property. We can work with our engineers to make sure you get the most in your 5, 7, and 15-year property so that it speeds up the depreciation on the facility and improves your cash flow. A couple more items here on tax planning, retirement plan contributions, cash balance plans, and any other profit sharing plans. Again, based upon your personal tax situations or the tax situation of the dealers, that could be something to look into to maximize not only the contributions and benefit for the owners of the company, but also the employees. So that's something to look at in terms of tax planning. Also, interest and advertising assistance on new vehicles. Basically, for tax purposes, you can defer any interest and advertising assistance you've received on your vehicles and inventory until those vehicles have sold. So the IRS has declared these purchase price discounts. So anything you have received the cash for on those assistance programs that you still have in inventory in December, you can do a one-time deferral on those items to take those out of income and record those as a purchase price deduction. Doesn't mess up your accounting really. We record a reserve for those year over year and adjust that, so it's not going to mess up your day-to-day accounting. Also on the used vehicles, making sure that you're writing those down to the book value. A lot of dealers use Kelley Blue book value, but basically making sure that you're taking advantage of that deduction as long as you're not on LIFO. If you're on LIFO for used vehicles, you cannot take write-downs on those. Okay, moving forward to tax compliance and reporting. A couple of things to note here on your demo vehicles. Again, hopefully you're doing this already, but making sure that the amount of the demo vehicle benefit is being included on the employee's W-2 as a fringe benefit. EPV typically is the code in box 12, I believe, that is used for employer provided vehicles. So we can help you with the calculation on what the best calculation is to use for your employees and your management of the company to make sure that it's getting reported at the right amount. Also make sure you're including shareholder health insurance premiums paid to anyone who's greater than a 2% shareholder. So HSA contributions, insurance premiums paid, those need to be reported as well, as those are taxed differently on their personal return. So that's something we can also help with, as it's typically a common thing we see omitted on W-2s. Also make sure with all your vendors and accounts payable that you've got all your W-9s in order, so that when it comes time to do 1099 reporting, there's no issues there. Those should be updated on a regular basis to make sure you've got EIN numbers and who truly qualifies for 1099 reporting and who doesn't. So that's something to always make sure you're aware of, and should be a good control to make sure you don't have vendors that aren't approved as well. So Form 8300 review, maybe not as common as it used to be, but making sure that you have reportable transactions that are over $10,000 or in the aggregate over $10,000, which can be tricky. If you have separate cash deposits that add up to more than $10,000, making sure that those still get reported on a Form 8300 is important. Again, not as common as it used to be, but still something to be aware of. Also, as I mentioned before, tracking of meals and entertainment, as the deductibility of those changed a little bit with the new tax act. A lot of times we recommend our clients set up different accounts for those so they can be tracked and easily identified and included in taxable income at year end if need be. Also making sure sales and use tax on purchases, whether you make purchases online, those should be self-reported. if you're in Ohio, to the state of Ohio, and you should be paying use tax on those. Also on loaner vehicles, which have become more and more popular with our dealers, making sure you're calculating and paying use tax on loaner vehicles that are provided free to customers. A couple of things in the last couple of years that have come out is the new Wayfair. The state tax nexus is a huge thing you've been probably hearing a lot about. Maybe not a whole lot of applicability for dealers who may be selling vehicles across state lines, which typically the vehicle sales tax has been, in 40 states have enacted this Wayfair legislation. So it's important to realize it's very common now, and almost all the states have adopted it. But for vehicles, not as important as the sales tax is going to be paid when the vehicle is titled in that state. But if you're doing a lot of parts sales across state lines, a lot of dealers get rid of their aged parts by putting them online, putting them on eBay and different sites like that to help get rid of some parts that they no longer need. So tracking those out-of-state sales in regards to Wayfair and Nexus can be key. So something to keep an eye on, and certainly something that the Brady Ware team can help you with and identify those issues and how to get those addressed with the taxing authorities. A couple of things on CAT tax for Ohio, making sure, this is pretty common, but making sure everyone's tracking their out-of-state sales to reduce their CAT tax liability. And also making sure if you have common ownership, if you have dealerships or entities under common ownership that are being consolidated into one CAT tax return, that you don't get $1 million exemption for every entity. You get one overall $1 million exemption. So that was a common mistake we saw in prior years, where if you had 5 entities in a consolidated return, someone was taking a $5 million exemption when you truly only get a $1 million exemption for all those entities combined. So that's something to make sure that you're taking a look at and getting corrected if need be. Just wrapping up, I wanted to point out we do offer, hopefully that was some helpful tips and reminders for you. We do offer, if you want to go onto our website starting tomorrow, we will have a controls checklist that we found very beneficial throughout our years of experience working with dealerships, and some great ideas on some controls to have in place at your dealership. And so you can go out to our website tomorrow and download that controls checklist. I think you'll find it very helpful, and hopefully some good reminders. So thank you everyone for attending. Here's my contact information. If you have any follow-up questions or concerns, or is there anything we can help you with in implementing some of these ideas, there's my direct line and email address if you have any further questions. Thank you.
Thank you, Tom. That was really informative. A lot of stuff you covered, both from the internal accounting perspective, some tax ideas going into the year end. So I appreciate everyone joining us for our webinar, November webinar, and hope to see you back in December for our December webinar, which will be a wrap up of 2019, a montage of some of the points we covered, and look forward to seeing everyone back in December. Thank you.